Hey, this is John Starks. You be down here on the street and you watching Taking Stock.
Time to rock and roll on this Tuesday, June 16th. All-time highs for the New York Stock Exchange Composite Index as well as for the Dow. 2 minutes to go here into the closing bell. Markets in mixed territory at this hour with the Dow set for yet another all-time high close off the strength of Goldman Sachs as it continues its push well north of $1,000 a share. Meanwhile, in the S&P 500, utilities, financials, industrials, those are your strongest performing sectors for today's tape here on Wall Street, and your S&P 500 laggards, tech, energy stocks, as well as communication services. Back to the Dow we go for a look at JP Morgan shares, 3M and Visa, your Dow leaders by a mile, your laggards, Microsoft, Nvidia, as well as Salesforce. Meanwhile, for the Mag 7 tech stocks, kind of a mixed bag, all things considered. Into the closing auction down here on the trading floor of the New York Stock Exchange, we are seeing shares of Alphabet in positive territory, about a full percent. Nvidia shares down at this hour, about 1.6%. And of course, all eyes on SpaceX, which at least briefly earlier today surpassed Amazon and Microsoft to become the fourth largest company in the world already by market cap. The crypto majors at this hour are in mixed territory. We'll talk a lot more about Bitcoin's intraday price performance in just a bit as it holds the 65,000 level. We got the team from Equinor. This is ticker symbol EQNR down here on the trading floor of the New York Stock Exchange. They are set to do the honors. Time now for the bell. All right, and there you have it, your final tail of the tape. For the S&P 500 in negative territory, almost 0.6%. The Dow 30 reaching an all-time high just north of 52,000, up 0.6%. JP Morgan, Visa, Home Depot, 3M, and Amex, your biggest leaders in the Dow. The New York Stock Exchange Composite Index also up at a record high close, up about 0.1%, with the small caps in negative territory today, down 0.9. Let's bring in the one and only, our very dear friend, Phil Rosen, Chief Market Strategist at ProCap Financial. My man, thank you for being here today.
Thank you for having me, JD.
Dude, these are wild weeks. We have so much to kind of go through. We could do an hour-long conversation on today's tape alone. More broadly, very close to all-time highs for the broader S&P. Any big surprises jumping out to you? As here we are, just another week where, at least for a few of these indexes, new record highs.
I think SpaceX's IPO went just about as good as you could have hoped. You saw a big pop, you saw another big pop yesterday. Today's pretty flat, and that's pretty much what you want, because if you saw a 80% run up in the first couple days, then you start to get a little worried, looks a little frothy, retail's in there, but I think we're actually doing pretty okay considering that most of the shares are locked up anyway. So SpaceX, that's the biggest story, fluctuating with Microsoft, Amazon. I'm not too worried about that. The biggest thing to me is that with the Iran war's peace deal in the works and hopefully going through, the AI trade has unlimited room to run now. The brakes are off. We're going to go much higher is what I think, because think about how strongly the bull market ran when we had an Iran conflict going. And now that it's hopefully off the table, plenty of room to run.
Yeah, did it surprise you yesterday that we had the big pop in equities yesterday? So there had been a very popular running narrative that all this was already kind of priced in or baked into the market. We get at least the announcement of a framework of a deal, and investors say, you know what, time to rip to the upside.
Everything is always priced in. The market is way smarter than any of us, and yet it can still surprise us. That's an amazing thing about markets. And we're seeing small caps lead the way this year. They've been so strong, doubling the S&P 500 just about. Tech is so strong. The AI trade is still so strong. Nothing is really that surprising when you zoom out and consider how resilient the bull market was during the Middle East conflict. And yet here we are, still at record highs, going to continue to break new record highs. Oil keeps falling, stocks keep going up. That trend will probably continue, and that's a very classic historical pattern as well.
Today was day one of the two-day FOMC policy meeting. We got Kevin Warsh set to make his highly anticipated debut, replacing the great Jerome Powell. Any expectations, day one jitters, I wonder, for Kevin Warsh? What are you going to be looking for? We get the decision at 2 o'clock tomorrow. His first press conference at 2:30.
I'm not expecting any changes tomorrow. I think Warsh is going to come out and say, we're not going to change interest rates. I think pretty much everyone expects that. That's what's on the table. The thing to watch will be whether he comes out and says anything about hikes. He's not supposed to be in there to be raising interest rates. Everyone expected him last year to come in, flatten rates to zero, just as President Trump had been calling for. Now the macro picture is a little more complicated, so I think his hands are tied. He's not going to be slamming rates down to zero. But if he mentions anything in the Q&A about potential rate hikes, which actually the market is expecting before the end of the year, that could send some jitters into the market.
My man, I need your take on what we're seeing for small caps. We talk a lot about on the technicals, potential for small cap breakouts. How about general outperformance? I mean, I'm asking you this question on a day when the Russell's down about 0.9%, but here we are, year-to-date performance almost 18% for the Russell 2000. What are we seeing there?
If you had bet on small caps at the start of the year, you were a contrarian, but you've done very well by that midway point, so that's a pretty good sign. And to me, look, small caps are the most economically sensitive corner of the market, and what's amazing is that they've continued to run up even as the markets have started to price out rate cuts and price in rate hikes. So really, we should have seen that reflected in small caps going down, but they've continued to go up even as borrowing costs might be getting tighter at the end of the year.
Phil Rosen, happy early Fed Day, my man. Thank you for being here. We love Fed Day at the New York Stock Exchange. Please come back and see us again soon, my man.
Thank you very much.
Nice to see you. And I'll take your mic. Todd, we'll head this way. Here are a few of the top analyst calls that moved the tape here on Wall Street this morning. First up, B of A upgrading ExxonMobil to a buy, calling the company's valuation compelling, especially if the peace deal with Iran, hey Judy, does not materialize. Shares up 17% on the year. Wolf, meanwhile, upgrading Palantir to Pure Perform. They call it the best product market fit of any major enterprise software giant. Palantir shares down 25% on the year. We'll go this way, Todd. Finally, Goldman reiterating Tesla as neutral. They say 2026 vehicle deliveries likely tracking ahead of consensus. 420,000 new cars is their forecast versus the existing figure of 205. Tesla shares down 11% so far here in 2026. We'll take a look at a couple stocks that called the New York Stock Exchange their home. How about shares of Flutter down 0.06% today? This is, of course, the owner of FanDuel. Analysts from Wedbush citing the FIFA World Cup as a significant boost for the stock. Wedbush initiating coverage with an outperform rating, a 138 price target. That's upside of about 25% off these levels. Shares are down almost 50% since the start of 2026. And we got to talk young brands. A big tape today, up about 2%. The brand selling Pizza Hut to private equity firm Long Range Capital for $1.5 billion now. There is a separate deal for mainland China locations. That brings the total deal to almost $3 billion. Pizza Hut has struggled in the young brand's broader portfolio, which of course includes names like KFC and Taco Bell. Shares up on the day, up 5% since the start of the year. The 2026 FIFA World Cup, meanwhile, is deploying the largest live AI system ever used in the history of professional sports. And Cheddar's own Chris Castellino went deep inside the tech with the man who is actually deploying it. Take a look.
On June 11th, the FIFA World Cup kicks off across the United States, Canada, and Mexico. 104 matches, 48 teams, and an estimated 6 billion viewers worldwide. But this year, what happens on the field is only part of the story. Because for the first time in the history of the sport, an AI system is watching every single player in real time across every play.
The World Cup takes it to a whole another level. It's arguably one of the biggest stages on Earth. We're very excited about bringing some of our cutting-edge technology.
Tolga Kortolu is the Chief Technology Officer at Lenovo, FIFA's official technology partner for 2026. Lenovo isn't just sponsoring the event, they're running it. The officiating, the analytics, the data infrastructure, all of it. This is the largest live deployment of artificial intelligence in the history of professional sports. And it raises questions that nobody's fully answered yet. About accuracy, about fairness, and about who exactly owns what the machines are learning.
Our overall technology development philosophy is to use AI as an augmentation tool. So the ultimate decision power needs to stay always with the referee, with the human.
In this episode of NYC Innovates, I went to Lenovo's New York headquarters and sat down with the one man who has to make sure that none of this fails, in front of 6 billion people. Stay with us. Lenovo is an $83 billion global tech company. You probably know them from your laptop. But the deal they signed with FIFA goes far beyond hardware. Lenovo is providing the entire operational backbone for the tournament. Devices, servers, networking, AI infrastructure across 16 venues in 3 countries.
We actually have a pretty long history of providing technology and being sponsor for sporting events, including F1. The vast amount of data, the vast amount of compute that needs to happen almost real time at all times is quite staggering. Everything has to work. No exceptions to that, of course.
And out of all the technology being deployed this summer, there's one system that stands out, and it may change the way officiating looks on live TV forever. Before the tournament even begins, every single one of the 1,248 players across 48 nations are digitally scanned. What emerges is a precise 3D model.
The 3D avatar system is, you can think of it as a digital twin of every single player, and it's the digital data combined with the player data as well as the ball location and things of that nature as well. The aim is to increase the fidelity with respect to player positioning, if you think about some of the decisions, offside decisions and things of that nature as well. It's all aiming at bringing all of that as an assistive technology for some of the decision making that needs to happen in real time.
In Qatar 2022, the semi-automated offside system drew some criticism. The player representations on screen didn't really look like the athletes. Critics said the technology undermined trust in the very decisions it was supposed to clarify. The 3D avatar system is the answer to that problem. But what happens when 2 players' limbs overlap on screen? When a defender's boot and an attacker's boot are essentially in the same pixel?
Object segmentation, extraction, and doing some predictive things with live video data is a pretty mature technology. So even if the viewing angle doesn't allow, we can do some generative things to be able to actually reason about which foot belongs to which player.
Welcome back to the show, and now I am thrilled to say one of our favorite all-time guests here on Taking Stock joins us live. Please welcome back to the program, Mr. Andy Bayer, Managing Director of Asset Management at GSR. It's a man with a new title. I got to make sure I get it right. Welcome back, my friend. Nice to see you.
Yeah.
Give me your latest take on what we're seeing in terms of price action for Bitcoin and the other major crypto giants out there. Are we seeing the bottom of the crypto bear market yet?
It's hard to tell, and all the pundits are out there saying, is this the bottom, is it not a bottom? Let's remember, pundits right now are conditioned to not call a bottom, right? Because any bottom over the last year would have been a false bottom. So if anything, in a punditry bias, they'll be hesitant to call bottoms, and they'll call for Bitcoin 50K, Bitcoin 40K. So I would say when you're reading things, note that it takes extra courage to call a bottom right now. I'm not doing it, others aren't doing it, but there's definitely a bias that way. I liked the price action of that last drop actually from 70s to 60K because it felt like a capitulation. It brought volatility back to the market. It brought a little bit of volumes back. Even funding rates and perps started to rise a little bit. And then this news coming out of Sunday night, which pumped up Bitcoin price about 10% and alts around 10 to 20%. I think it's healthy. It'll draw attention back to the market. So overall, the market's healthier than when it's going like this.
Andy, we are seeing tremendous demand right now for yield.
Yes.
Give me your take on the latest developments that we should know in terms of stablecoin yield, DeFi yield, and how it all connects to the same conversation.
While the markets are flat, people are sitting on a lot of stable coins, and whether they're posting those stable coins as collateral or they're holding on to it as dry powder, they want yield. So the thing that in our asset management business that we're getting called for most is, how do I get yield? How do I get safe yield? How do I get yield that I can unwind in one day? What's the term premium looking like? So one thing we always like to look at is, where are traditional finance yields right now? So if I look at SOFR, if I look at the treasury curve from 1 month out to 1 year, those all are around high 3%, right? 3.6, 3.7, 3.8%. So I checked out the rates on Aave, on Gauntlet, on Stakehouse, on Morpho. These are all DeFi, borrow, lend platforms and vault platforms. Guess where yields are? 3.6, 3.7, 3.8%. They're all about the same, which implies that there's no premium. You're not receiving extra money to take DeFi risks right now. Now, I don't think that implies that DeFi is as safe as US Treasuries, What it does imply right now is that there's so much demand for yield and so little demand for leverage that those rates are all the same right now. I don't expect that to persist, but it is quite striking.
Andy, crypto investors woke up today to, well, they wake up every day to a lot of headlines.
They do. Sometimes they never go to sleep, and they don't
well,
wake up at all.
That's correct.
That's
well, listen,
right.
see, hey, this is the tough part. You follow a world that trades Saturdays, Sundays,
Correct.
whereas equity
Waking up,
brokers
you've
don't.
lost me. Yeah.
But this is the big one today. What's waking up? BlackRock launching a new Bitcoin ETF, generates income specifically using covered call strategies.
Right. Yeah.
How big of a deal is this?
I think it's following. Goldman Sachs filed for a similar ETF, which was their first maybe a couple of months ago, and Grayscale and others have had products like this for a while. In the crypto native world, we're seeing a tremendous appetite for option selling in a lot of tokens, including Bitcoin, because people want to feel like these tokens, especially those that don't have a staking unit like Ether or Solana, they want them to be spinning off some kind of income. They want them to be working for them. This has compressed Bitcoin volatility quite a bit right now, so you're getting less for your sold call options than before. You end up with a profile where you're getting some cash out in exchange for more or less giving up some of the upside in your Bitcoin holdings. So it's a different way to experience Bitcoin ownership. I wouldn't call it yield, and I'd be very suspicious of others who call it yield, but it is an interesting way for people who want to combine some long Bitcoin exposure with some income coming in. The fact that BlackRock is launching in there means that they see demand for this, just like we do in the crypto native world.
Andy Baer, the worst part of my interview with you every time you're on the show is that at some point it has to come to an end. I'm so grateful to see you again, my good friend. Take good care of yourself.
Thanks,
Andy
JD.
Baer, Managing Director, Asset Management at GSR. Don't go anywhere. A lot more Taking Stock coming up live right after this.
And time now for your Kaiko signal. SpaceX taking the stock market by storm, but investors were working on price discovery on DeFi exchanges weeks before the IPO actually launched. Now, pre-IPO perp volume slowly picking up in late May and increasing through last Friday, which was the day of the launch. Now, these are crypto derivatives that allow traders to speculate on price, and on Friday you saw a massive spike to over $8 billion. Binance leading in terms of volumes with nearly half, and OKX attracted 30% of volume, while Hyperliquid saw less than 20%. When we look at the price of the perp futures tied to SpaceX, we saw a sharp decline from mid-May. They began over the $200 mark before falling to below the $160 level a few days before the launch. Now, Binance waited for SpaceX's official filing to list contracts and adjusted for dilution when more shares were announced. This aligns with the downward price movement And meanwhile, OKX and Hyperliquid's earlier contracts did not account for a stock split. And that's your Kaiko Signal, courtesy of Kaiko, the global leader in digital asset data and infrastructure.
Thanks a lot, Remy. FinTech TV recently launched Capital Markets Americas to MENA. It's a first-of-its-kind show that connects Wall Street directly with the Middle East. Earlier today, FinTech TV anchor Ragda Ibrahim sat down with Coin Bureau founder Nick Puckrin at the ADX in Abu Dhabi. Take a look.
Joining us now is Nick Puckrin. He's a former Goldman Sachs analyst and founder of Coin Bureau, a research and education platform that built its name in digital assets and now covers the wider investment landscape from AI to macro. Hello, Nick. First, thank you for joining us today. And let's start first with a bigger story also that we saw this weekend as well. Let's start with the deal now. And US and Iran agreed to end their war. Oil tumbled, as we see, and gold and Bitcoin both rallied. Walk us through what happened with the markets.
Well, yeah, I mean, I thought after 39 times, could this be the final one? Yeah, when I saw the news. So it seems as if we could be coming to some sort of a resolution. It's now, they're going to sign the deal for a 60-day, it's an MOU. So as you all know, an MOU is more like a memorandum of understanding. It's not legally binding. So that's going to be signed on Friday. Now, the markets have taken a breather. Obviously, we've seen stocks rally, risk on assets, oil has collapsed, bonds have rallied, yields have come down. So the markets are taking this at face value. Immediately, exactly. It happened yesterday. It happened on the weekend with regards to crypto prices. So I know that it's a very tenuous time right now in terms of like trying to, in terms of how quickly things can change. And there's still a lot of outstanding questions, including what's going on with Israel and Lebanon, what's going on with the nuclear enrichment, the Strait of Hormuz. But right now, markets are rallying and taking a sigh of relief from this, and it's taking all risk assets up with it.
I think we're going to see now till Friday, as you mentioned. So gas prices here in the UAE also just hit a 4-year high. Could we see a relief at the pump now?
In terms of petrol prices for load?
Yes.
Well, yeah, I think it's the petrol and oil is a homogenous commodity around the world, right? So if prices come down, the spot price comes down, and global spot price comes down, it's going to impact on downstream synthetics of that fuel itself. So therefore, we should see a relief in terms of fuel prices here in the UAE as well, and gas prices.
Yeah, it's going to be our good news
exactly.
for the week at least. Now, all right, back to SpaceX next. SpaceX is now trading around $192 from its IPO price, which was $150. Is that valuation, or today's valuation, let's say, is it justified?
By most traditional metrics, no. In terms of you're talking at current levels of a market cap of 2.2 trillion. So it went to IPO at 1.75 trillion. It's now 2.2 trillion. If you're taking it at an $18.7 billion in revenue from last year, we're talking about 143 times revenue, which is just unheard of for a new company coming to the market. So in terms of valuation, but you're paying for that revenue, it's incredibly high. But then again, many people are betting on the vision in terms of what Elon Musk is selling, in terms of the future for orbital data centers, for the AI play, this whole AI hyperscaler build out. So they're pricing in a lot of potential upside. And indeed, the banks have got, quite optimistic projections in terms of where revenue could be, even in just 3 years' time. For example, all of the banks like Goldman Sachs and Morgan Stanley, they've got projections of the AI part of the business 100x in terms of revenue in the next 3 years, just for that AI part. So there's a lot of hopium, the term we use, to basically built into that valuation. But I think Elon Musk's track record speaks for himself.
Thank you, Nick, for joining us today. Thank you so much.
My pleasure. Thanks for having me.
Thanks. Appreciate it.
for a new edition of Talking Stock, a new segment on the show where we feature a new unique viewer question every day. Manuel on Twitter asks, what will Kevin Warsh's approach to interest rate cuts look like? On the one hand, Kevin Warsh was actually known to be a pretty hawkish Fed governor when he served in that role from 2006 to 2011. On the other hand, we know the president's approach to monetary policy. He wants to see a more dovish Fed, in other words, lower rates. Regardless, I say, Kevin Warsh stays data dependent but could emphasize different data than his predecessors. Don't forget, the C in FOMC stands for committee, not chairman. First decision tomorrow at 2, the press conference tomorrow at 2:30. And now Money 2020's very own Scarlett Sieber is back with a whole new edition of Hindsight 2020, where she breaks down important key dates in financial history. Take a look.
I'm Scarlett Sieber, Chief Strategy Officer here at Money 2020, and this is Hindsight 2020, where history reminds us that the most important financial shifts, they often happen not in the markets, but in the response to them. So let's rewind back 100 years almost, back to May 27th, 1933. The United States is in the Great Depression. Banks have failed, depositors have lost trust, and the financial system is operating on fumes. And let me tell you, there was a lot of them. So what does Congress do? They passed the Glass-Steagall Act. On its face, the law does two simple things. First, it separates commercial banking from investment banking. Second, it creates federal deposit insurance, what we now know of today as the FDIC. But in hindsight, Glass-Steagall did so much more than just regulate the banks. It redefined confidence at scale. By separating risk-taking from deposit-taking, the government drew a bright line between speculation and safety. Ordinary depositors no longer had to assess whether their bank was well-run. Their money was backed by the state. That's a big differentiator. That single shift stabilized the system, not because it eliminated risk, but because it redistributed it. For decades, this separation shaped behavior. Banks knew what kind of risk they were allowed to take, depositors stopped running at the first sign of trouble, and finance, well, it became boring, deliberately. Fast forward to the late 1990s, when Glass-Steagall is repealed. Risk, it recombines. Complexity, it returns. And just over a decade later, the system tests its assumptions again in 2008. Back to that day on May 27th, 1933, it reminds us of a core financial truth. Stability doesn't come from eliminating risk. It comes from deciding where risk is allowed to live. Every modern debate around bank regulation, fintech charters, and financial supervision traces back to that moment. That is Hindsight 2020, because when trust collapses, the most powerful response isn't innovation, in fact, it's actually boundaries. With that, back over to you.
Hello and goodbye. Thanks for watching today's edition of Taking Stock live from the New York Stock Exchange. Have a great Tuesday night. We will see you again tomorrow. Woo! Nicely done. Nicely done.